Hello and welcome. My name is Dennis Hungridge. I want to spend a few minutes with you today to present a final project for my financial accounting course in the MBA program at California University of Management and Technology in San Jose. In this course, we've explored ideas and skills involved in the accounting processes needed to satisfy the generally accepted accounting practices set for all publicly held companies. Starting from the fundamental principles, we have seen how transactions flow in debit and credit format from T accounts to journal accounts to general ledger, and finally to the four basic accounting statements: the balance statement, the income statement, statement of retained earnings, and the cash flow statements. Using the expanded transaction analysis model, we can follow the impact of transactions through the debit-credit process affecting assets, liabilities, stockholder equity, revenues, and expenses. Transaction by transaction, each entry contributes to a financial picture culminating in a company's annual report. It is this report we will review today. Boston Brewing Company produces Samuel Adams beer and other craft brews and has celebrated its 25th anniversary in 2009. We will use this 2009 annual report to evaluate decisions and look at some of the results. Quoting from the annual report, the company's goal is to become the world's leading brewer of better beer category by creating and offering highly qualified, full-flavored beers. The company sells its products through a network of over 400 wholesalers nationwide and internationally. The brewing business model has been a balanced strategy of brewery ownership with production and production arrangements with third-party breweries. Starting in 2007 and 2008, the company moved to a more aggressive position in ownership, acquiring the Pennsylvania brewery for $56.5 million. We will see the impact of that transaction shortly. To begin, let's look at the brewing sector in general. This sector has been characterized by significant consolidation over the past 10 years, culminating with two large mergers in 2008. S.A.B. Miller plc and Molson Coors Brewing Company combined their U.S. operations, and InBev completed its acquisition of Anheuser-Busch to create Anheuser-Busch InBev. Together, these two giant companies comprise 94% of all U.S. domestic beer production. Boston Beer operates in the, quote, better beer or craft beer segment, characterized by offerings of better quality, flavor, and higher unit price. This segment has seen an increase of approximately 5% in volume and revenues at a time when the overall beer segment has declined 1 to 2%. I will focus today on the statement of cash flows to see if we can figure out what's been happening at Boston Brewing. We will attempt to answer these four questions. 1. Which reporting approach did Boston Brewing adopt for its cash flow reporting? 2. What is the quality of earnings ratio for the current year? 3. What is the capital acquisitions ratio for the last 3 years? And 4. What portion of cash from operations is paid as dividends? So let's look at number 1. The cash flow reporting for Boston Brewing was reported in the indirect method, as most companies do at this level. As you can see from this cash flow report, the detail is absent, and these are generalized entries for all the cash flows of this statement. Number 2. The quality of income ratio is a function, as you can see, of the cash flow from operations divided by the net income. These numbers are all expressed in thousands. That ratio for this past year, 65,565,000 divided by 31,118, gives us a ratio of 2.11. The impact and the major elements of this ratio on the cash flow side were depreciation and amortization of 16 million, prepaid expenses at 6,484,000, and outstanding accounts payable, and stock-based compensation at 4106. That's 4,106,000. So each of those elements contributed to driving down the ratio that we would like to see a little bit higher. The capital acquisition piece, item number 3, as you can see, is a function of the cash flows divided by the cash paid for physical plant, property, and equipment. In this case, we have a number that's a little surprising. Over the past 3 years, we have a ratio of 1.56, considerably below what we'd like to see. Upon closer examination, however, if you break this out year by year, you can see in 2008 the ratio really tanked, and that was primarily due to the acquisition of the Pennsylvania Brewing Company. So in 2008, a 0.67 capital acquisition ratio really put the skids to the other 2 years. Finally, the dividends. Again, reading from the annual report for Boston Brewing, the holders of Class A and Class B common stock are entitled to dividends on a share-for-share basis only if and when declared by the board of directors of the company out of funds legally available for payment thereof. Since its inception, the company has not paid dividends and does not currently anticipate paying dividends on its Class A or Class B common stock in the foreseeable future. Since this company started out as a privately held company, and one person started, that one person controls the overwhelming majority of the Class B common stock and presents in some ways a risk to the company going forward. I hope this has been enlightening for you. Look for some additional documents to go up on my blog and also a potential PowerPoint. Thank you very much.